Inflation is coming down. Interest rates will come down pretty soon, most likely.
Feel like it was pretty weak pre-COVID.
The RBA need to change gear. That is the time that we're in right now.
Yeah, I'd even go one level higher.
Is a property boom just around the corner? Are we sleeping on a big buying opportunity right now? Inflation is coming down. Interest rates will come down pretty soon, most likely. We have housing approvals that are dire, housing completions that are even worse, and we have the hallmarks of everything you need, the macro conditions that you need for prices to actually rise. So despite property prices being at their peak level today, are they actually about to be undervalued in the years ahead? In this episode, we're going to make the case for a property boom in the years 2025, 2026, and 2027. The next 3-year window could be that buying opportunity right now. That's exactly what we're going to go through. Kurt, you know this topic gets me excited. How are you?
Yeah, this is a good one. I like this because gives all the listeners a bit of an insight into our normal discussions where you come in with like, I sense some amazing opportunity, I have a case for it, and my job is essentially to be like, I don't know about that. Convince me.
There's a decade of this, right?
Yeah.
We've been doing this for a decade. This is basically the hallmarks of our friendship. This is how it began. We met in Treasury, and I remember having ridiculous ideas sometimes, and Kurt and I would go for walks around Lake Burley Griffin. And on those talks, I would be like, Curtis, the dollar is too low right now. It's going to be an appreciation. Be like, but Curtis brings in reason to my madness sometimes. So I want you to play that out for our audience right now, because I'm looking at this and I'm sensing, something is brewing, something good is brewing for property investors, maybe not so much for those who plan on buying in the year 2028 and beyond, but something could be brewing here, because when I look at those macros, they're positive. Like there's a lot of good signs for property in the years ahead.
Yeah, no, poking holes in your theories is one of my most entertaining, the most entertaining parts of my life. So I'm good to get started.
All right, let's go. So you got me with the pro-boom phase, pro-boom arguments, and you got Kurt balancing it all, and we'll talk through the detail here. So we're going to go through 4 or 5 key metrics, the macro metrics that will support a boom in the next few years ahead. So let me define what boom is. I'm going to call it 20% plus appreciation in national property prices, driven by major capitals, probably Melbourne, Brisbane, Sydney in some of this as well, because some of the other markets have already had their time in the sun. So we're talking about a 20% plus appreciation in the next 3 years, maybe even 30% plus.
And fairly widespread. Not every market, but like you're saying, national property prices. So we're talking just broad macros, that there's that kind of rise.
Yes, exactly. So the key reason, or one of the key reasons, I'm going to end with the main reason, but one of the key reasons is the monetary and fiscal environment. So we're obviously operating in very tight monetary conditions at the moment. The cash rate is really high. Household consumption levels are very low at the moment. They're moving backwards in Sydney, Melbourne. Households are under the pinch at the moment. That's pretty clear in the data. But that trend could be reversing in the course of the next year. CBA, every major bank economist is predicting 4 to 5 rate cuts, bringing in the cash rate down to about 3%. That promotes borrowing capacities up another 15%. And this year, it's only been 3 months since those tax cuts have fed in, and that's a $20 billion stimulus to the household sector. That also promotes borrowing capacities, helps people borrow a bit more. And over the past few years, and for this 3-year window, you've got another 10, 15% increases in net incomes as well, which also supports property prices. That is, a feature that you have all the time. And as long as that wage growth continues over the next few years, you have that working for you as well. These are macro factors that really help people borrow more money, provide access to more credit, and that typically leads to higher property prices.
Yeah, so increased demand basically is how I would describe this factor. Is we are expecting, and I think it's a pretty reasonable expectation, that both fiscal and monetary policy are going to increase demand relative to where they are today. I think this argument is probably a matter of quantity. Like if there's 2 rate cuts and then it holds for 9 months, then that's not really going to move the needle that much. We're still in pretty restrictive monetary conditions. It'll give you a little boost to demand, but it's not going to change the game. But you get to 5 or 6 rate cuts, that starts to be a real material uplift in borrowing powers that are close, to that 20, 30% mark that you're talking about anyway. So you're allowing people to access an additional amount of credit that's consistent with the kind of price rises that you're predicting. So to me, that's where I see the difference here. It's only going to go in one direction, like it's going to add to demand. But the part that's debatable is is it little or is this massive?
What side are you on? It's only going to go in one direction. That's the sentence.
Well, we're not going to have rate we're not going to have rate rises.
I'm going to hear that line. It's only going to go in one direction, said from the genius man himself. When you put it like that, it's going in one direction. It's a question of how much.
Exactly.
How much of a firepower booster are we giving to that property market? I think that comes down to a little bit of an inverse relationship is how slow the economy goes.
Yeah.
The slower it goes, the quicker inflation comes down, and the more sort of turbochargers the regulators will put in, the RBA will put in, be like, hey, look, let's fire Australia up. Let's fire it.
It's a balancing act between inflation, unemployment, and economic activity, basically.
Yes.
Where if you have the risk to your argument is that if you do have a Goldilocks case where the economy and unemployment remain relatively okay, then chances are you're going to see less loosening of monetary policy. So you're going to have less rate cuts, which would then have less emphasis on the upside of what you're predicting. I think that's the risk. There's two risks to your case. That's probably the most plausible risk. The other risk is that it all goes way, way, way worse than everyone's expecting, and there are a huge number of rate cuts as a result of very, very bad economic conditions and high unemployment, which crashes everything.
Yes.
So you're kind of looking for a bit of a sweet spot where things go maybe slightly worse than the RBA and the government want, which precipitates a little bit of more slightly looser monetary policy than would otherwise be needed, but not so bad that the conditions actually negatively impact house prices.
Yes, that, and I'm looking at one new bit of information as well. So this is a little bit of an update since our last podcasting sort of session and the last few podcasts that we've done is lead inflation data is coming in really, really soft at the moment. So inflation is a measurement of how prices change, and it's an all-in-one measurement that the RBA are looking at because they're looking at a broad metric of how prices are moving. But there's a lot of lead data sources that go into that broader measurement. So you can track rents week on week. Is that going up? Is that going down? You can track electricity prices, fuel prices, a whole range of the components inside the basket you get early indicators on. Like just go to the browser and be like, hey, what am I paying this week versus last week? Am I paying more? You can do the same thing for a whole range of things, and that comes out in our quarterly CPI data, along with the monthly prints that feed up that quarterly data set. Now, all of those lead indicators, they're suggesting inflation's coming in a lot softer than expected, and that is really what the RBA will need to see to have rate cuts kick in and also increase the quantum of rate cuts. If the inflation problem isn't there and growth remains really slow, then they could easily adjust the patterns of monetary policy to be like, hey, it's time for neutral interest rates in Australia because inflation's, well within band, comfortable, and we have comfort in that. That's going to take a bit of time. That's going to take over the course of the year. We get comfort in that. But let's just play this scenario out and be like, cool, all the major economists think there's 5 rate cuts. That in itself is probably enough to drive this macro change because that's pretty substantial. But then, there could be a little bit more beyond that if this inflation story does continue to eventuate over the next 6 months or so, and inflation does come in a bit soft. At the same time, we have employment fairly, ignore the last 12, 24 months. Broadly, we have more people employed than ever before. And it's 2 million people plus over the last couple of years. There's a lot more people in jobs than there were just a few years ago. That means a lot more people are earning income. Inflation's going back down. We could hit this Goldilocks scenario. The numbers look a little bit different to having a 3 handle on employment. But this Goldilocks scenario, this soft landing scenario is becoming more and more likely.
Possible, yeah.
Every month we go forward. You have pretty strong macro factors here, especially when these rate cuts actually kick in, if these rate cuts kick in. And let's add one more little bit of information to this beautiful story for everyone out there is some major banks or almost major banks, have so big banks, very big banks, have been cutting their fixed rates. There's one bank out there that have just ended their 539 for a 2-year fixed offer. That's nearly 75 basis points, 3 rate cuts baked into the price of a fixed rate loan. That has been on the table for the last month or two. So for the last month or so. So you have banks even cutting in their fixed rates and projecting that out. So you have some of this rate story kicking in. And if you did get interest rates down to that 3% level, so call that roughly neutral, you have owner-occupier rates in the high 4s and investment rates in the early 5s. That's kind of where
it would land,
right? It's pretty attractive. Mid 4s sounds pretty attractive, like when you start doing the numbers there, especially in some capitals.
6, yeah.
Yeah, it gets really attractive because I look at this and I compare it to yields of that city. Like right now, Sydney's got a 3% rental yield and a 6% interest rate. It's ridiculous. Anyone who owns an investment property in Sydney is losing money a lot.
Hand over fist.
Yeah, hand over fist. It's a lot. It's like half the value of the property. If you have a $5 million portfolio, the bigger the loss is going to be. Even if you don't have debt against it, you could take that money out and put it against just cash asset returns and you can generate income. So it's generating a loss and that spread will come down. But at 4.5%, the spread in Sydney isn't so pretty, but spreads in other capitals start being like, this spread is very, very small because rents have shot up so much as well. So there's a little bit of a numbers game to this as well. The macro rate changes could actually just change the numbers so much where it's just like, these numbers are pretty positive. They look really good.
Yeah, interest rates falling by that quantum is going to be attractive to everyone. As long as the economy and the employment market hasn't totally tanked alongside it, like you say, that's good for owner-occs, it's good for first home buyers, like people trying to buy PPORs have more borrowing power, investors are getting better yields. So that all makes sense.
Yep.
Like I say, it's a question of quantum. I don't know that anybody really has that good of an idea of what the neutral interest rate actually is.
Yep.
Like obviously there's a number in the RBA's like modeling, but I think that is when you're talking about, yes, there's, 4 to 5 to 6 rate cuts to kind of get back to neutral territory. I think that's very much like, we'll see how that plays out.
Yep.
And that neutral interest rate could end up being a fair bit higher than that. No, I don't think anyone really has a good feel about where that's going to be until we actually land there.
Yeah, exactly.
Because I think for 6 rate cuts, you're really talking about inflation going out the bottom end of the band is the way I kind of think of it. That's actually going to generate that many cuts. I don't think inflation is going to hold neatly in the band and you're going to cut rates 6 times and it's going to stay in the band. I think that is actually the RBA tracking inflation and being like, hey, I think it's going to go at the bottom end of the 2% band and we are actually cutting rates to a more normal monetary policy setting to keep it in the band. Because if we stay restrictive, it's going out the floor. And I don't know, I think there still could be a bit of stickiness to get below 2 or to have it tracking below 2, if that makes sense.
Yeah, that's true. I agree with that.
Basically, I think there's a bit of risk. There's a bit of risk there. There's less monetary stimulus than people are predicting.
There you go. Curtis is here. There he is. It's just like, rein it in, Redom, rein it in. These 6 rate cuts, that sounds questionable. And very much so. It is questionable as of today. For our audience, they'll want to know, the US has had a 50 bip rate cut.
Yep.
New Zealand is on a rate cutting spree. They're just going cut. They can't cut quick enough at the moment.
Yep.
They're probably going to go back to back, maybe even have a 75 bip rate cut, being like, I actually wouldn't say we've overcooked it. We've beaten inflation and our economy is slowing down really, really quickly. We need to get interest rates down to 2 to 3-ish%. We're at 5.5%. We're miles away from where we need to be. Let's cut quickly. That's what they're doing right now. They're across the ditch from us. They're right next to us, right? They have an economy that's quite similar to ours, obviously much, much smaller, but it does give you a telltale sign of what's going on and what every other Fed is doing. Europe's doing the same thing.
Yeah.
Everyone is on the same mission at the moment, and it's not, let's cut slowly. It's, we have interest rates far too restrictive, which they did, right?
Yeah.
Like Australia is not in the same boat.
Yeah.
But they're not cutting rates to we need more time here, but the New Zealand could cut interest rates 2% in 3 or 4 meetings. Like that's a big expected drop in interest rates, and they've already had a little bit of a drop that was a bit too slow. What can Australia lean on with this story that's becoming a worldwide story? What What can we lean on from the other central banks' decision making here, or is it much of a that's their countries? They've chosen a different path to Australia. They picked higher interest rates, which means more aggressive cuts. What's your take on this?
Yeah, my take, because everyone, especially the Fed, is all over this. I think it's a little bit overdone, to be honest. I think it's a little bit more of they're different countries. They have their own economies. They have their own inflation data. And I don't really subscribe to the theory that we're just running, 6 to 9 months behind the Fed. Maybe we are, but I think our circumstances are a little bit different, not in any particularly special way. I think it shows that rates are going to come down, which is probably obvious anyway. But I think the way those countries put rates up and the stickiness of their inflation could be different to what we have. The stickiness of their employment markets, like that comes down to like your industrial relations law, how easy it is to fire people, as to how quickly like employment data can change, or how quickly, you can lose people out of the workforce. So
it's a lot we don't know yet.
There's a lot we don't know. And the Australian story so far, to me, seems like we are stickier than the other countries. Our economic data is stickier than the other countries. Is my interpretation of it. And I feel like there's a case that might occur on the downside as well, if that makes sense.
I think that is just on. I think
it could just be a 6-month lag, right? Yeah. It's like, we're just 6 months behind.
I think we're starting to see that. I think we're starting to see the unstickiness, like the inflation free fall that we've had.
That's what you want. You want free fall. You want it going out the bottom of the band. I think forecast to be going out the bottom of the band, because that's when you're going to get 50 point. That's when you're going to get serious cuts, right? Because then the RBA. Because if it lands at 2.5% and stays there, then the RBA aren't going to cut, basically.
So I'm going to make the reason why I actually think there's a chance that the super boom, so let's change the super boom, I'm going to call it. The super boom theory exists because if inflation continues to fall and our growth figures remain around that 0 to 0.5% quarter on quarter, we're growing at roughly 2% per year, and employment continues to slow down, and that pace of slowdown needs a change. The RBA need to change gears from going from restrictive monetary policy settings to easing conditions. We need monetary policy that helps support the economy. We don't need neutral interest rates. We need interest rates that support economic growth. I think that is the change that some countries around the world are working at, and we could be in that same conversation by the end of this year or early next year. Australia could be in the same realization. They won't say it. They can't say it straight away. Maybe they will when they start cutting rates, being like, hey, we need to cut rates. Like, it's becoming obvious and we're late on the curve. We've been late on this curve intentionally because we need confidence that inflation is coming back down. But the problem we have at the moment, Australia, is this could be Michelle Bullock looking at the camera and saying, we have a bit of a problem. Interest rates are here. The economy is slowing. Inflation is coming down and employment is moving backwards. Why do I have interest rates that are slowing the economy down? I need interest rates to help boost the economy. Kind of like I need tax cuts in 1 July 2024. I need interest rates to boost the economy. If that conversation is at any point in 2025, 2026, or 2027, you now have interest rates well below 3%. You have interest rates around that 2% mark as a baseline minimum to help support the economy. And you have a clear number where it's just like, we have interest rates in supportive conditions. Whatever the neutral interest rate is, to have a clear, concrete, evidence-based argument that interest rates are now supporting the economy, somewhere around that 2%. It'll have to start with the 2 handle because, the way the RBA worked that out is, where is inflation? 2 to 3%, and they add in productivity, which has been next to nil for a period of time. Their math would say 2% is a number where it's like, we're helping support the economy. Don't know how much, but we're now in conditions to help support the economy. Now that is a 25, 30% increase in borrowing powers. You probably have APRA kicking in being like, let's throw some fuel in, let's reduce some credit controls in as well. We just need to be all on Team Australia again. That scenario could easily start supporting a super boom scenario. So if that does happen, right now, property is like, those settings are 2% cash rate. And these settings, the rest of the things that we're about to go through, does promote severe undervaluation of property assets. Like, these needs a lot of things to happen, but we're talking about a 3-year window. Like, that's a long period of time, and that's the conditions that I'm kind of talking about. I'm talking about 5 or 6 rate cuts, everyone's talking about, and then the cream on top, the super boom bit, where it's just like not 30% anymore. You're talking 40, 50%, where it's just like property prices just fly off again, being like, oh, okay. What creates that? That's the underlying macro story. And we're just at the beginning of that, and we don't know exactly the quantum of what that's going to be.
Yeah, and like, to be honest, I think the demand side, the monetary fiscal policy demand side of it is the weakest part of the argument. Because that's the part where I see the most variability in potential directions. The part that we're probably going to move on to right now is actually the stronger part of your argument, like on the supply side of things. But I think that case that you've outlined, I think maybe 2026, 2027, I can definitely see interest rates needing to be in an easing position, because I don't really, depends what happens with economic growth, but I kind of feel like it was pretty weak pre-COVID. And I don't really see any fundamental changes in the economy or the way we do business or our productivity that means we're all of a sudden some kind of growth machine.
Fingers crossed, but
yeah, well, maybe we are, but like I could see we go back to a relatively low growth status quo, and that requires rates, to be easing by the back end of that window. But high degree of variability there. I don't know if that would be my base case. But like I say, the stronger part of your argument is if you flip and start talking about what's happening on the supply side of things, rather than the demand side, because the lead times are longer. And that's where I feel there's a really, really good case to be made that you could see prices jump.
Yep, exactly. So that's the main demand side. So we've covered 3 sort of separate areas here. We've talked about the macro conditions. We've talked about yields increasing, so along with really low vacancy rates. So we'll talk a little bit more about the supply side there, but really low vacancy rates and rents have shot up, helping support property through this period of time. But assuming that rent stays flat or continues to rise at a much more modest pace over the years ahead. And then we have the strong labor market. So forget about unemployment rates, forget about the news, the media, the pitching of it all. Just really, really simply, let's just look at a chart in how many people have a job. Very, very simple. Like, answer that question, and let's look at the data to that, because when you have a job, that is the foundation starting point to buying an investment property, buying a home. It is the individual. It is the individual. How many people have a job? When I look at a chart of this, I'm like, we have a weak employment market, man.
No, this is Michelle Bullock's favorite line too, because she doesn't like talking about like the unemployment number. She's like total employment, because it's paints a bit of a rosier picture that like, cool, we don't lose jobs basically. Our unemployment rate might go up, but we don't go backwards.
Yeah, look at this. 13 million people employed in roughly August 2020, so just before COVID hit. 13 million people before the big drop-off during COVID. Took, a year and a half to get back to catching up all those COVID jobs. But since then, 13 million people in jobs. Now we have 14 and a half million, 1.5 million jobs added. It took 6, 7, 8... It took about 7 years to create 1.5 million jobs last time. We've done it in 3 years. 1.5 million more people are out there in jobs, earning incomes, able to buy property, able to buy an investment property, able to get a loan. That is a lot of people in jobs. And this line doesn't even need to continue to rise. It's just like, 1.5 million people. That's more transactions that occur than the property market in total for a number of years. Like, that's a lot of people. So that trend, if we just remain, if unemployment continues to go up, that's fine. As long as this employment number remains in and around this level, that's a really, really strong demand force, especially in an environment of lower interest rates as well.
Yeah, but that's where this chart and interest rates might be inversely related.
Yes.
So that's where if the employment market remains very, very strong, that decreases the percentage chance that you're going to have your 5, 6, 7 rate cuts.
So that's very true.
Those two things, a little bit inversely related. So you take from one hand and give with the other a little bit in terms of a super boom.
Yep, that's very true. We've also got online job ads, so the lead indicator, down 20% in a year. So we we have clear slackening in the labor market. It's clearly slowing down, right? Like that is very, very clear. Unemployment's gone from like 3.3% to 4.3%. It's up a percentage point in the year. And yes, it will continue to rise over the course of this year and maybe early next as well until those rate cuts kick in. There's nothing to suggest, even in the lead data, that unemployment won't continue to increase. But the but from a property perspective, unemployment rates don't mean like
we're not bleeding jobs. Like from an economy-wide perspective, they're being added at a slower rate, basically, relative to the rate at which population is being added.
Yes, exactly. Okay, now I got our final reason, and this is the main reason why a property super boom will happen over the next couple of years. I think I've changed my tone. I'm talking to you, I'm like, property boom, and now I'm talking to everyone else, property super boom. I really like that word. That's fun. Super boom. What a fun word to say. Sounds like something I'd talk to my daughter about. Okay, property super boom. The reason for this is, hear this, everyone. I'm going to say it twice because it's absolutely ridiculous. Housing approvals are at 2009 levels. 15 years ago, we were approving the same number of homes as we are today. 15 years ago, housing approvals are at 2009 levels. Housing approvals are not increasing. In fact, they've kind of just been trending down. They've risen a little bit in the last couple of months, but have been trending down over a number of years. No matter what the talk is, I'm going to build 240,000 homes per year. I'm going to do this. I'm going to do that. Government talk, blah, 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 blah. I turn on SBS. I turn on ABC. They have talk. Everyone's talking about building more homes. No one is building more homes. In fact, we keep going backwards. It is a disaster of a performance for Australia. This is a horrible, horrible result where you're building such few homes. You're not even getting close to your target. You're not even hitting targets that you hit beforehand. You're missing by a mile. We're going to miss this year. We're going to miss the next year. We're going to miss the year after. We're going to miss the year after. We're going to miss the entire year period from 2025, 2026 to 2027. I think maybe 2027 is a little bit too far, but we're missing in 2025. I don't even
reckon it is.
We're missing in 2026, and we're missing by a long shot. All at the same time, we have some of the highest population growth rates that we've had. Vacancy rates are at their lowest level. There is no existing surplus of stock under every metric, in every capital, wherever you look. Rents have been shooting up, and housing approvals suck. So the reason why housing approvals matter, providing some context, is when there's an increase in demand, if there's a corresponding increase in the number of homes available for sale, an increase in supply of new homes coming into the market, assuming all the existing homes in the market are being soaked up via renters and homeowners, the new supply coming in, the new constructions, you need that to support
soak up the demand. Yeah.
The demand, the increase in the number of people wanting to buy. Otherwise, that ain't happening.
You draw your little supply and demand curve. If you don't move supply, price goes up. Yeah.
Yeah. So, what do you think about this? Poke a hole in this one.
Yeah. No. This is the argument. And if you are a property investor, this is, to me, this is the thing where I'm like, almost no matter what happens, this kind of protects against a property crash. It's there's so little supply. That's coming online in the next 2-3 years, because when you're talking about changing demand, you're talking probably about things that can happen in a 6 to 12 month window, being reasonable.
Yep.
If one rate cut's not going to do anything, but you could easily have 4, 5, 6 rate cuts in an easing cycle over a 12-month window. That's totally plausible, right?
Yep.
So in a 12-month window, you could be seeing a pretty, sizable 30, 40% increase to demand. But on the supply side, that is not going to come online for years down the track, right? So this is where you, as a property investor, you're pretty protected because there's just so little supply that's going to come online in the next 2-3 years.
Yep.
It's going to be very hard for you to go backwards.
Yes.
I think the debate is how much of an increase in demand is there, and where does that leave you in terms of your net growth? Are you just creeping along with, your 5% per annum or your 2-3% per annum that gets you to 10, 15% over that 3-year window? Or if there is a big increase in demand, no one's going to start, supply is not going to come online, new approvals aren't going to start, 25, homes aren't going to be for sale until 26, realistically 27. So like you're going to have a 2-3 year window where you've got this increase of demand and you have no increase in supply.
Yes. That is my summary to it. So let's summarize this, breaking our traditional sort of soft calls. I'm going to say that a property boom, the seeds of a property boom are here right now. Sydney house prices are moving backwards right now. Melbourne house prices are moving backwards right now. Melbourne house prices are 5% off their peaks. There is a window of opportunity for people to be buying before these demand conditions start kicking in. We are also going to provide a balanced perspective and talk through what will cause property prices to fall and crash, the complete opposite of these podcasts. But I am here looking at you, talking to everyone and saying that these conditions are really strong. The macros are very, very supportive. And if these rate cuts kick in like expected now, that looks increasingly likely every month we go forward, then you have the hallmarks of everything you need for property prices to be severely undervalued right now and a golden opportunity over the next few years. I think this could be a little bit of a seesaw ride. So we could have property prices soar upwards over the next few years, and then this approval
then
dynamic
supply comes online.
Yeah, the supply dynamic could come firing in because there's so much impetus. All that talk will eventually lead to something, but it'll be 3 years later, right? There could be an oversupply in those years that could drive property prices back down, which could cause a little bit of a roller coaster. But if you want to be on the upswing of that roller coaster, and when property prices rise, they only come back down a little bit. History has told us that even when supply kicks in, we've got so much evidence of that. That's pretty much every housing chart that you look at.
Well,
That is the time that we're in right now.
Yeah, I'd even go one level higher in the sense of if you just go for a very macro level, credit conditions are probably going to ease to some extent. You can debate how much over the next 2 years. And if you're an investor in Australia, what asset class has the most stuffed up supply side? Like if you could invest in shares, you can invest in whatever, right?
Yes.
So you're going to be like, all right, there's going to be some looser credit, more demand for assets, just in general. Invest in art, cars, whatever you want,
This is
right?
investing in government incompetence.
Well, yeah, but what asset class has the most stuffed up and longest lag supply kind of chain that is going to be unable to adjust to rising demand? And
Exactly.
I think
love it.
that's housing.
I love it. Curtis has just summarized it. I'm going to call it for what he just said. You can invest in government incompetence. Housing approval is really, really low. At the same time, they burn up credit conditions and allow people to get more money, provide more capital to property investors and homeowners to go and buy a limited amount of housing that's out there and not adding in enough at exactly the same time as having population growth rates really, really high. This is government incompetence that could easily cause property prices to rise. And you can almost bank on it. Like that's what the data is telling you right now. And if this actually happens, you have the conditions for a property boom. And one more thing I'm going to leave you with is we need to talk about housing approvals because the what is going to be booming. There is specific sectors, specific markets to be looking at, specific markets not to look at. It is not a uniform story. You can't just go buy units because we said units are going to do well. Some areas have unit approval shooting up while other areas have unit approval shooting down. So we will unpack this housing approval story because in this super boom story, housing approvals are the key factor to look at to tell you exactly what will do well and what won't and when the time is to do really well. Kurt, pleasure.